Good afternoon, everybody. We will be going live shortly. We're just waiting for more participants to join us. And it's 2 minutes past, so we are going to get started. Good afternoon to everybody and welcome to today's webinar. My name is Sarah Simson and I'm the Head of Fiduciary Services for Sasfin. Now, we've found that many clients have been considering either setting up businesses offshore or offshoring local businesses. It is well known that Sasfin is renowned for being passionate about business, and we recognize that in a rapidly changing, complex world, business owners constantly need to learn and adapt to emerging risks and opportunities. So this session is intended to assist in highlighting the complex legal and regulation challenges that a business owner faces constantly, whilst trying to apply their creative energies productively. Because of the growing popularity of offshore trusts and the numerous day-to-day queries that we get, we are going to be delving into the setting up of offshore businesses held by a trust, as we know that a business owner cannot afford the unintended consequences of venturing out into international diversification without professional assistance. This is particularly true given how competitive and challenging businesses can be. To this end, we have a panel to guide you through the basic checklist of considerations that form part of step 1 of offshoring a business. We will be running these sessions in series as to focus on specific areas, and therefore this session basically makes up part 1 of the series, which is the foundational basics. So business owners, this is your step 1 checklist. Joining us today on the panel is Ernest Marais. Ernie is a highly experienced cross-border tax attorney and director at Anderson. Ernest has participated on a number of these client sessions, and Anderson has a global network that assists us and our clients in ensuring that any South African advance dispensed that could potentially touch on an offshore jurisdiction is well considered from every angle. Welcome, Ernest.
Thank you, Sarah, and thanks for the flattering introduction for having me today. Look forward to speaking to you.
Also joining us on the panel today is Ferreira, a VP at Intercontinental Trust and expert on setting up offshore trusts and businesses. Intercontinental Trust is one of Sasfin's authorized providers on offshore trusts and company structuring services. So welcome for the first time today, Anne.
Thank you. I'm loving my new role and looking forward to this discussion today.
To our audience, please post any questions that you may have by using the chat function. We are going to get to as many questions as time allows throughout the session and towards the session if time allows. Well, please also note that the session is being recorded and that if any slide is going to be referenced and any speaker decides to pull one up, you're most welcome to reach out to that speaker, whose details will be shared towards the end of the session. And as we have a lot of content to cover, without further ado, we are going to get started. So I think, and we're going to start with you. So I've just tuned in. I'm a business owner and I'm watching the session here today. What are my main reasons for wanting to offshore a business?
Well, Sarah, each company would have their own specific reason, but let's go through a few of those. Companies' first reason for going international is to take advantage of the international competitiveness they would gain. It would diversify the company markets through growth and expanding operations to multiple countries then. Going international would generate more revenue as you can compete for new sales. The expansion allows for diversification of a client base that could be saturated in the current country of operations, such as South Africa. You can achieve cost reduction through volume and scale. Applying the same formula of your business reduces the overall cost. The business would have access to double taxation agreements, and Ernest, I'm sure you're going to be touching on that later on. It reduces the tax burdens of foreign investors and provide legal security to investors. The second reason, or most common reason, would be very relevant to South African companies, and that would be that they are able to do business in a hard currency. This would be, for example, doing business straight through in USD or Euro. A hard currency can be any currency that holds its value over time against major currencies. South African companies have to compete against global competitors whose pricing, purchasing, and profits remain in the same currency throughout the whole process. It is the currency margins that can kill the company's profits. Dealing with this unpredictability of a currency's fluctuations add additional stress to financial planning and costing for a company. In South Africa, we do have CFC accounts that can alleviate some of this pain, but the profits are not allowed to remain in hard currency in the CFC account indefinitely. So any ZAR conversion always has a larger margin that is applied, and this is the difference between the buy and sell rate than the margin between two hard currencies, for example, between USD and Euro. This makes the competitiveness of a ZAR-based company always on the back foot. For me, another main reason is protection of your brand in the international arena. It gives you the rights to international brand registration and builds international brand recognition for your company. Improving your company's reputation through strong legal support system, as all companies would sign contracts with both your suppliers and your customers, this now on an international legal support system. Expanding your business doesn't just give you access to international client base, it also gives you access to a broader pool of talent and skills to develop your brand and client loyalty. Good delivery through skilled labor at a competitive price always builds client loyalty and your brand. And then lastly, for myself, I would say that it would be the access to foreign investment opportunities. First of all, for growth of the company, as there's a robust legal network that provides protection for the investors. This provides an opportunity for growth through the investment. But also, you'll see we go through a discussion with our clients each time. And the first question we do always ask is, what is your exit strategy? Every business owner or shareholder must consider an exit strategy. An international company will attract a much larger international investor pool and not just SA-focused investors. This provides for a much better exit price as it takes the country risk component and more investors would be interested.
Thank you, Anne. So I think this really highlights that every good shareholders agreement needs a brilliant termination clause, as does every marriage made in heaven even, it needs a good anti-nuptial contract. So I think it's very important to plan the beginning with a premeditated potential end in sight. So I think, Anne, could you maybe give us an example of the type of clients that you deal with daily? It's very difficult as a business owner sitting at home to know if this is applicable to me. I've tuned in. What are the kind of day-to-day clients that you see? Can you give us some examples, please?
Well, Sarah, August is Women's Month, so let's celebrate a lady that did very well. Let's use the example of a client that had a niche market of supplying high-end corporate clothing to Kenya and Tanzanian hotels. So she went ahead and explored the options available. She then proceeded to set up a clothing manufacturing company in Mauritius itself. Mauritius has a duty-free zone, and this client was willing to set up a factory in the Mauritius Free Port. She's importing the cotton and the material duty-free and with VAT exemptions. The company further benefits as it has only a 3% corporate income tax rate, and also further benefits because of the reduced port handling charges. The restrictions she had to adhere to are that majority of the products had to be exported out of Mauritius. The local Mauritian market, which also obviously for her had a large hotel base to supply, she is allowed to do that, but this portion is then taxed and the income tax rate then remains at 15%, same as a domestic company. The important part is that the majority of the product must be supplied to African, European, and US markets. As this was a requirement, she could easily meet with her contracts that she had in Kenya and Tanzania, and then still had the capacity for growth into European markets on the same shipping route, benefiting from that. So this would work well for companies willing to do business with politically stable and well-regulated African jurisdictions, and still have the possibility to find new markets in the EU and the US to benefit from the trade agreements such as the Interim Economic Partnership Agreement and the African Growth and Opportunity Act, which provides preferential access for goods based out of Mauritian origin to the European Union and the United States. Let's use another example of a client that Since a young age, you were asking about trading. He worked in agricultural farms in East Africa down to Zambia. Through his time spent on these well-established farms, he built up a network and knowledge base that he did not know he would be able to use later in his life, working on these farms. When he decided to settle down, he met his future wife during a European holiday. And she had experience in the food retailing market. They combined their skill set and when they wanted to have a more stable lifestyle and started a family. Through his network of knowing the best produce, reliable supply, and access to transport and ports, combined with her network of food retailers, they set up their first offtake agreement through a trading company set up out of Mauritius. This has grown to a year-round supply of fruit, vegetables, and nuts, mostly to European countries. So I would sum this up and say, if you have a niche market or skill set that can be scaled internationally, you are the ideal candidate for taking your potential internationally.
Thank you, and I love hearing real life case scenarios. It's far more interesting than just listening to the law and the basics on funding. So thank you very much for that. I think, with that landscape set, what I'd like to move on to is what endearingly term as the legal stuff. So I think, Ernest, over to you. Legally speaking, are you allowed to set up an offshore company? What is your process? And what would the formalities be that one would need to consider in this?
Thanks, Sarah. I think without sounding like a typical lawyer, I must answer you and say it depends. There are exchange control regulations applicable in South Africa, which means that you can't transfer capital out of the country, you can't transfer money out of the country without prior approval. If you're an individual wishing to invest offshore, you can take out up to R1 million per annum without any strict approvals. If you take out more than R1 million, but up to R10 million, you can utilize your foreign capital allowance, which will require you to obtain a tax clearance certificate from SARS or tax clearance PIN. And if you're taking above R10 million a year out, that is allowed. However, you will need to, the process will involve a more detailed audit of your tax affairs, and there's a big money laundering investigation on you as well. So you're raising a lot of red flags when you're taking out more than R10 million per annum. Businesses, they can invest freely abroad up to R1 billion per annum. There are certain requirements. Obviously, the investments need to be aligned with your current business. For example, an active trading business can't go and buy a property in Portugal for the owner. You're never going to get approval for it. It needs to be aligned, and you need to obtain certain rights within the foreign target, such as at least 10% of the voting rights and of the equity rights. There are, of course, exceptions to the rules. It's the exchange control regulations or a guideline. So we always recommend that if you've got something that's out of the ordinary or just with the ordinary, we're obviously happy to guide you in the right direction as what needs to be done. And lastly, for South African trusts, unfortunately, you're not allowed to invest offshore at all. So trusts can invest via a company or can invest or you can distribute funds from the trust to an individual, and that individual can then invest offshore. So that's basically a high-level summary of the rules and the regulations. And we typically will then recommend people going to speaking to people like Intercontinental Trust to help with the actual implementation of setting up companies, setting up a trust, opening up bank accounts, and those kind of things.
So, Ernest, you mentioned a good management company, for instance, Intercontinental Trust. So, and over to you, what sort of process would this take to set up the structure? How long does it take? And I'm going to restrict the ambit of this question to Mauritius only, otherwise I think we will be here for days, if not weeks.
All right. Firstly, Intercontinental Trust will engage with a client on their business processes. We would first have to understand the client himself. What are the future structure in terms of shareholding and management and expansion plans? This is to determine who are the key individuals in the business. So we would engage to have a complete understanding of their business and ask questions such as, for example, what industry they are in, their competitors, what can be done to enhance any advantages they have, what countries they are operating in, from where are they procuring, supplying to their clientele, or operating or manufacturing in. What is the expected turnover, profit margins of the company? These are just some examples of the exploration phase. After understanding the business operation, we would engage on the portion that everybody enjoys the least: paperwork and compliance. The compliance process is from completing a business plan, which forms the core of client acceptance as well as regulatory acceptance, as it details the above understanding of the new company. And to identify the ultimate beneficial owner, the warm body behind the business. During this process, we have gone through the types of companies available and determined which would be beneficial, of which today I'm only going to highlight an authorized company and a global business company. So these names already allude to what each is about. So let's highlight some of the features. And if you don't mind, I'm going to just share a screen quickly with you also, and which has a good set out of as a comparison. The global business company is tax resident in Mauritius and benefits from the tax treaties. When you hear tax resident, you might want to ask, what is the tax rate then? This is 15%, but certain streams of income, for example, your investment holding company receiving dividends and interest, will benefit from partial exemption of 80%. This brings the tax rate down to 3% effective. In comparison, an authorized company is not resident for tax purposes, but in turn is not eligible to benefit from the tax treaties. For a global business company, the foreign investors and directors may apply for occupational permits, but for an authorized company, they cannot apply for an occupational permit. What is required to obtain these benefits, you might ask? For GBC, the most important is substance in Mauritius. The company will also need to have its core income-generating activities in Mauritius. A further requirement is the submission of audited financial statements and filing of the company's annual tax return. Again, in comparison, for an authorized company, there's no requirement of substance in Mauritius. The core income-generating activities may not be in Mauritius, and there's no requirement for submission of your annual financial statements. Yet, there's still a requirement to file an annual tax return. So, to sum it up, what this table basically says to you, to every client out there, is that there is not one size that fits all. And that's why the exploration and planning step with the client together with ITL is so important.
Thank you for that, Anne. And as you said, there's quite a bit of information on there. So can I just prompt any attendees that would like that information to reach out to you? Your details will be shared at the end if they do want to explore these discussions further. Also, if this is loaded on the content tab, they're welcome to go back and reference that screenshot if they do want to look at it again. And I think, you know, something that you said here is every legal practitioner's disclaimer: one size does not fit all. And I think, Ernest, this really, what comes to mind with this is that there really is a multitude of offshore jurisdictions that are available. And as a professional myself, I find the selection so daunting that I really feel this must be an enormous challenge for a business owner faced with this decision-making process. So could you maybe enlighten us how you decide on an appropriate location to set up a business, and what should our attendees be considering?
Thanks, Sarah. I think again, I'm going to default into my standard answer of it depends, and we'll need to discuss look at the actual business of the owner. Things that we usually look at is the strategic location of where you're doing business. You know, I very often find it odd if a company is doing business between Africa and Europe to go and set up a holding company or a trading company in the Caribbean or the Far East, just for time zone differences and a multitude of reasons. It's very often questioned as to why are you making use of a trading entity or buying into an agency that's being completely outside of the geographic proximity of where you're doing business. Another thing that we will look at is the governing legislation of the appropriate jurisdiction and the structure that you intend on using. We very often prefer using jurisdictions that are based on the English common law and that are roughly, in principle, very close to the same as to what we have in South Africa. The issue with often using civil law countries is that they don't recognize some of the legal concepts that we have, such as trust. And if you've got a French company with a trust, that trust, they don't treat it the same we do, and it may not have the same tax implications or the same legal implication as you intend to be. So it's always worthwhile looking into the actual governing legislation. We also look at stuff like the compliance, the FATF recommendations. Is the jurisdiction FATF compliant? The FATF recommendations are usually compliance, and the Financial Action Task Force issues recommendations on anti-money laundering and compliance. If you in a jurisdiction that's grey listed or that's been raised, that's been red flagged by the FATF, you'll have issues with banking, you'll have issues with payments being made to that jurisdiction, and you'll find yourself in a continuous process of having to explain to your buyers or your sellers or your customers why you're set up in this jurisdiction. But I think most importantly is substance. I think Anne alluded to it earlier. At the end of the day, you need to go to a jurisdiction where you intend on actually getting warm bodies on the ground, where you intend on doing business in that jurisdiction. If you're going into a complete random jurisdiction, there may be questions as to why you're going there, and if you're going there solely for purposes of treaty shopping or looking through or tax avoidance, SARS and the relevant tax authorities will look straight through that entity and completely dismiss it. The presence of double tax agreements are important, and then also the financial and banking infrastructure. There's no use in setting up, I think Anne alluded to the benefit of having a hard currency, doing business with hard currency. If you're not able to access US dollars or euros or whatever it may be in that foreign jurisdiction, it kind of questions as to why going there in the first place. But yeah, that's again, it's rough guidelines, and I think at the end of the day, it'll depend on the nature of the business.
So I think you mentioned something, FATF, which is a highly emotional issue at the moment for all us South Africans. So I think we're going to steer well away from that and perhaps come back to that at a later stage. But you did mention the international banking infrastructure. So I think we're going to put Anne on the spot here, because Anne's had extensive experience in this field, having been with Ferreira for many years prior to joining Intercontinental Trust. So Anne, we really want the nitty gritty here today, not the stuff we can Google. So we really are putting you on the spot. Now we want to know, what is going to be the first step when you look at banking options for a South African business owner? And for instance, would there be any type of restrictions on trading activities that would preclude a business owner from opening a bank account?
So you asking about the business activities that would be restricted that we would have. So this is a very relevant question when you consider the jurisdiction for your relevant business and activities that you outline in your business plan, which was the first step. The obvious is to avoid on the international arena would be the high risk, ultra high risk activities. So very obvious, the weapons, the dealing with sanctioned countries, and for example, sanctioned animal trade. We live in Africa. For us, it's normal. For the rest of the world, it might not be. The activity must be legal in the jurisdiction of registration. That's very important. But also the jurisdiction of registration, operation, and where the bank account is held. Gambling might be legal, for example, in the country of operation, but will be prohibited by the bank where you opened your bank account. E-commerce is another one that that cannot be accommodated by all parties. This is due to the banks, and especially their corresponding banks, requesting information on each payment coming in. And as you know, on an e-commerce site, you won't always know who you sold that pair of shoes to. So not all parties have the capacity to deal with the cost of such high compliance. Another topical activity is cryptocurrency trading. Here the question is mostly on who the crypto partner is and how to confirm if it's your own funds that you invested that's being returned to you, or is it somebody else's? The business activities are a minefield to go through, and again, this is where selecting a reputable management company such as ITL is important.
Okay, and so let's say, for example, hurdle number one has been satisfied. They do manage to open a bank account. I think the next thing on every business owner's mind is scalability, and intrinsic to scalability is funding. So what type of funding would be available to such business owners? And I think I'm not going to restrict you to Mauritius, so let us know internationally or Mauritius. You might want to restrict your own answer. It's up to you.
All right, so in South Africa, Sarah, South Africans are used to very high levels of debt. That's both personally and for companies. This is not the trend internationally, which is far more risk adverse. A term loan is probably the most popular for companies. A term loan is earmarked for a specific need or a project and has a medium-term repayment period. They are offered in different currencies. This is important because the currency would match the cash flow currency and then match the repayment of the loan. Your international banks has since the end of 2021 moved away from LIBOR rates, and this was replaced by the risk-free rate. Now, risk-free rates are benchmarks generally based on the overnight deposit rates. They are considered to be more robust as they are based on a larger volume of observable transactions. The impact on a company requiring financing is that the risk-free rate appears to be lower than LIBOR, as they do not incorporate the term and the bank credit risk, but the bank can add this during the negotiations. So be mindful of that. Trade finance is also another popular option. It will fund your account payables and receivables in line with the working capital needs of the company. This unlocking your cash from your receivables and payables, ensuring that your movement of goods go through the supply chain. Another trade finance option is documentary credits, collections and guarantees that mitigate your payment and performance risks through documentary trade finance. Trade finance is wider than just applicable to banking, as there are private companies or funds that specialize in trade finance. ITL ourselves, we have a network of sister companies, has access to assist with bond raising or listing requirements that deals with specialized capital finance.
Thank you, Anne. And typically, are there any certain types of industries that would be easier to finance than others?
Sarah, it's not really industry specific, but there are some industries that have larger assets holdings on the balance sheet than, for example, your service-orientated or your consulting companies, which have little to none. They have no assets on their balance sheet. These companies are always easier to finance as there's often a requirement for collateral from the financier. Internationally, also consider that your jurisdiction, where you would choose your bank, jurisdictions with a strong banking network is easier than if there are only a few weak banks in the jurisdiction. Further, if the bank, your holding company and the operating company is in the same jurisdiction, it does simplify any legal framework for the loan agreements. Lastly, if there's a strong parent company to rely on, it always simplifies and makes a favorable credit application for approval.
Thank you for that. And I guess, as business owners, we love learning from everyone else's mistakes so that we can avoid them. And it really does save the rest of our school fees. So if you can tell us, in your immense experience, if you could just limit it to a few, what are the most common mistakes that operating companies make when applying for finance?
So I would say, let's list 4 points here today. I would say the most common mistake is that your financial statements are not prepared and ready. Now, on an international company, this is a forced requirement, so the probability of that happening is probably less. Not having good corporate governance in place. Again, that will be strengthened by a good management company and a corporate structure. Remember, financing backs the jockey as well as the horse. So for me, a personal one, which was in South Africa often happened, was a misappropriation of funds, shows lack of financial discipline. This often happens when companies' owners use the company as their own personal piggy bank. And then lastly, I would say, have a very clear, sound business plan drawn up. It shows clear strategy, it defines your plan and understanding of the business, and it conveys it to the financier, which makes the financing options then easier.
And you mentioned using your company as a piggy bank. I can see Ernest over there has actually grimaced at the very thought of the tax and exchange control nightmare resulting from doing this. I'm actually not sure, either that he was just smiling in anticipation of all the fees that he's going to tally to fix such rookie errors. Sorry, Ernest, and I promised no attorney jokes, but I could not help myself there. And yes, I think you mentioned that, and now we know why FATF is where it is. And I think, the one thing on everyone's mind is the quantum of cash that they can borrow. So typically, how much money would a business owner be able to borrow, and how would this be quantified?
So cash flow of the company is the core basis of any loan repayment. The cash flow must at a minimum match or exceed the repayment amounts and the terms that it happens in, or the future payments that's coming up. Loan repayments is based on the term of the loan and the interest to be paid, plus the capital portion. The term is based on the project that is being financed, or, for example, the asset's lifespan. From these variables, a loan amount is determined. Again, remember, collateral may be requested, which is the exit for the financier if things go wrong. This could lower the amount that is being offered to you.
Thank you. And I think, we've also would want to know, for instance, what type of grants or tax holidays would be granted to someone in the industry? Is it industry specific? What would be the determining factor in order for them to find out if something like this would be available to them?
This is always a fun subject, because the grants and the tax holidays are available in most of the international jurisdictions, but they do unfortunately change on a continuous basis. They are extremely beneficial, as we showed an example of, for example, the clothing manufacturing in Mauritius early on, making the expansion possible. It improves the cash flow and it reduces the time to reach profitability. These incentives are brought in on a continuous basis as the need to promote specific industry in each country becomes relevant or required. So it's a political and a financial decision that's made by each country. It's thus prudent to keep on top of the information and consult continuously, as a new incentive might become relevant to you as a business owner. Don't take that what is there today will not become future beneficial for yourself.
Thank you. So I think the only thing that we can rely on really here is that all of this is unreliable and it needs to be established perfect at that time endpoint. So I think, we've been chatting a little bit about funding, and when we speak about funding, I think there's one chilling factor that comes to mind for every business owner, and that is the word suretyships. So Ernest, could you maybe explain to us how this would work in an international landscape?
Yeah, so I think, again, we're dealing with exchange control regulations primarily. If you're trying to give a suretyship or give a guarantee from a South African person, or taking security of a South African asset, that any security or any guarantee given will be subject to exchange control approval. I mean, as you can imagine, the Reserve Bank are not very fond on you loaning funds abroad, triggering a security, and then that non-resident coming and taking an asset in South Africa without those funds ever having flown to South Africa. One of the key requirements of the and one of the fundamentals of our exchange control regulations is that any acquisition, any assets, or any export of capital that's happening from South Africa abroad needs to be at fair market value. So you can see how that can become problematic by issuing suretyships or guarantees from South Africans for an obligation abroad. However, it's not a complete and entire no. Again, if it's within your foreign direct investment allowance for businesses, or if it's within your foreign capital allowance as an individual, you may approach SARB and see if you can get regulations. Again, like I said, these regulations are more guidelines, and at the end of the day, if you can show benefit to SARB, if you can show benefit to the South African economy, you may very well get approval for it.
So I think the thought of a guideline as opposed to a hard and fast rule could be quite chilling, because it doesn't give us a lot of certainty. But I think even more chilling than the topic of suretyships is definitely the subject of tax. And now I can see Ernest definitely going to smile because this is his best subject ever. I think this can be very treacherous for our clients to navigate. So what would be key considerations if you look at the tax? And if you can maybe just give us an example, everyone wants to know, if I just set up a company offshore, how would that differ from setting up a trust and the trust holds shares in the company?
Yeah, thanks, Sarah. I think it's fair to say that there are obvious tax benefits of making use of an offshore company. I think Anne alluded to it earlier. Alluded to Mauritius having a corporate tax rate of 15%, and sometimes qualify for an exemption of 80%, which gives an effective tax rate of 3%. I mean, that's miles better than the South African corporate tax rate of 27%. However, there are various things that you need to keep in mind, and you need to keep in mind each taxpayer in the process. You can't just take a position, and I'll briefly touch on that. For example, a company, the tax residence of a company is determined by its place of effective management and not by its place of incorporation in most cases, in most instances. So, for example, if you incorporate the company in Mauritius, however, the entire board of directors are sitting in South Africa, all the key decisions, all the strategic decisions are being made in South Africa, that company will not be deemed to be a tax resident of Mauritius, but will be deemed to be a tax resident of South Africa. So you'll only have a registered address, and you'll be subject to Mauritian company laws, but you will not you'll not benefit from the Income Tax Act in Mauritius. Interestingly, other countries such as the US, the double taxation agreement between South Africa and the US refers to the place of incorporation. So you can have a company incorporated in the US with the entire board of directors sitting in South Africa and still be seen to be a US tax resident. So that's first of all how you determine the company's tax residence. The second thing that you need to look at is how will the shareholders be taxed if you're sitting with the South African shareholders. Now, if 50% or more of the shares in a foreign company are held by South African tax residents, be it either companies or individuals, that company will be deemed to be what's referred to as a controlled foreign company. Now, a controlled foreign company, once you have a controlled foreign company, the shareholders of that company will be taxed on the net income of the company. So there's no need, even if there's no dividend distribution, even if there's no money flowing from Mauritius into South Africa, I'm using Mauritius as an example, irrespective of that, if there's net income of that company, your shareholders in South Africa will be taxed. And if it's an individual, you tax in your personal income tax rates. If it's a company, you tax at the corporate tax rate, and like I said, a trust is not allowed to invest offshore. However, it's worth mentioning that a non-resident trust, for example, a Mauritian trust or a Singaporean trust with South African resident beneficiaries, are not seen to be a South African taxpayer for tax purposes. So again, provided that the trust is managed outside of South Africa. So what we'll typically see, a lot of people will what they'll do is they'll have an offshore trust, hold 50% or more of the shares in a foreign company, with the remainder of the shares being held either by individuals or companies. That's quite a nice, useful structure. Then again, if the company is a tax resident in Mauritius, and a tax resident, again, Anne mentioned, and remember, you can't have an authorized company is not a tax resident. It's only a company, that's a global business license company, which can be a tax resident. And then you need to show that you've got substance in Mauritius. In a case where, let's use an example of a Mauritian company with the shares being 60% held by a non-resident trust and 40% held by a South African individual. If there's a distribution of dividends to the South African individual, that individual will not be subject to tax in South Africa or in Mauritius. Two reasons: there's no dividend withholding tax in Mauritius, and secondly, that South African holds more than 10% of the shares in a Mauritian or foreign company, and they'll benefit from what's referred to as a participation exemption by virtue of holding more than 10% of the shares. Now, this may sound too good to be true. However, the reason why SARS have introduced this legislation is to encourage shareholders of foreign businesses, to encourage that company to declare dividends, to have that funds flow back into South Africa, to allow you to spend that money on South African soil and then stimulate the South African economy. Trust is unfortunately not as simple. Any distribution from, again, let's use dividends as an example, any flow of dividends from a company to a trust will not be, from my understanding on Mauritian tax laws, there will be no dividend withholding tax going from the company to a trust. However, on distribution from the foreign trust to a South African tax resident, that individual will then pay tax on that. If it's a dividend, they'll pay normal dividends tax, or you'll be subject to a highest maximum rate of 20% on that foreign dividend. It's worth mentioning, and I know there's a lot of rumors going down that a few years ago that you can, if the trust receives a dividend, you just leave that on the trust in the financials and have it flow over for a year or two, in which case it will convert into capital, then you distribute the capital. Unfortunately, SARS have closed that loophole by saying that they'll look back to see what is the original nature of the income, and that will still be taxed as dividends at a tax rate of 20%. So that's roughly the tax considerations. But like I said, it's quite complex as to, and there are a lot of moving parts. Again, I recommend that you take formal advice prior to the implementation of a structure.
Thank you, Ernest. I think with everything that you've explained, you've actually answered two of the questions that have arisen in the chat box. I think you've dealt with those quite succinctly. And I think, in a discussion like this, I know that you could probably get started on loops and speak for the next hour, but this is something that we hear a lot about in the media. And the only thing that seems to be clear is that there's absolutely no clarity at all. So we want to know from you, what can we do and what can't we do?
So it's like you're mentioning, it's a very grey area of the law at the moment. Just to give you some background, prior to 2019, South Africans, the loop structures was not allowed. Now, just to explain again, a loop structure is a situation where a South African resident holds an investment in a foreign target, for example, a Mauritian company, and that Mauritian company then holds an asset back into South Africa. Shares, whether it be shares, property, whatever it may be. In 2019, there was a partial lift on this, on the ban on loop structures, and then in 2021, 1st of January 2021, there's a complete lift on loop structures. And the current regulations, as it's drafted, saying that any loop structures will need to be placed on record with the South African Reserve Bank, and any South African assets that's acquired will need to be acquired at fair market value. Now, so within the law, within the regulations at the moment, loop structures are allowed, and it's perfectly allowed. However, what happened within the last few years is that people tended to abuse the structure. There's a lot of abuse of the structure going on, and we understand that the South African Reserve Bank are in the process of issuing new regulations to curb this abuse of the system. So what's happening is, if any non-resident holds shares in a South African company, that shares will need to be endorsed as non-resident shares in order to allow you to say the funds come back into South Africa. And if you want to take that funds out back into Mauritius, you need to present a share certificate that says it's non-resident. At the moment, by virtue on the instructions of the Reserve Bank, from what we understand, these share certificates are not being endorsed as non-resident. So that's what's creating a lot of confusion. We've submitted various applications saying that we are compliant with the law, and the banks are simply not answering the question and simply not endorsing the share certificates at the moment. However, any other assets where you don't need an endorsement, such as property or those kind of things, as the regulations are currently drafted, you don't need to ask permission. You merely need to put that you have a loop structure on record.
Thanks, Ernie. I think it's a very difficult position for listeners to be in, to understand that there's absolutely no clarity. And chatting to some of the leading experts in the country, they also don't have clarity. So it's not ideal. And I think, leaving our listeners in the untenable situation of not knowing what potential opportunities or risks are presented by expanding through these various loop structures, we wouldn't know what to do. What would your recommendation be? To wait for clarity or to go ahead with the status quo? Do we say there is lack of clarity and perhaps I see this as an opportunity, or there's lack of clarity and this is too much of a risk, so I need to wait to see what clarification we get from the authorities?
Sarah, again, it depends on the nature of the assets that you want to acquire in South Africa, and it depends on whether you foresee an immediate cash flow happening anytime soon. If you want to take profits out of the country within the next acquire an asset that will produce a lot of turnover, and you tend to take dividends out on a regular basis. I'm going to tell you there's no use in doing it now, because you're not going to be able to take out dividends. Your dividends payments will not be able to flow from South Africa to a foreign country. However, there are situations where I think it makes sense. A lot of the times we're doing it, we're making we're structuring these transactions, making it conditional. So we'll enter into a sale of shares agreement of a South African local company to a foreign entity, and that agreement will be conditional upon the endorsement of your share certificate as a non-resident, which means that the agreement doesn't take effect until such time that the share certificate are endorsed. It allows you time to basically do the transaction, establish a value, and get your house in order. There are other people that's using a resolutive condition, saying that the agreement is effective. However, if we don't get approval, the entire agreement, the entire transaction collapses, and we revert to our original position. Depends on cash flow. A lot of, like I said, there's a lot of variations that we again, if you're acquiring property, I think that's a much easier transaction to do, and you can only place it on record. So again, it depends on what you want to do and what your appetite for risk are. If you're entering into some form of and again, I know there's a lot of advice, if you're into some form of a obscure structure where you're trying to strip dividends out of the country without paying fair value for that asset, I can almost assure you that you're not going to get approval, and that the pending regulations is going to be designed to curb any abuse of the system.
So thank you for that, Ernest. And I see there is a question that popped up, and I think it might be worth stating that perhaps the question has been raised too late to go into it, but the question was raised about Mauritius being recommended to set up an IP holding company. And I think, I don't think there's enough time to answer this, but what would your passing comments on that be?
I mean, I think Anne can comment on Mauritius as being an appropriate jurisdiction. The only high passing comments that I'll make is that the intellectual property is seen as a form of capital. The export of intellectual property there's very strict rules and regulations governing that, and it's and if you take that out without the necessary approvals, without the necessary systems, you may run into trouble. So again, with the Exchange Control Authority. So I think it's something that, again, specifically on IP, please seek advice prior to trying to move IP offshore. It's an extremely complicated part of the law. But Anne, I think you can comment on the appropriateness of Mauritius as a jurisdiction.
So let's assume that it has been set up correctly, that there is substance in Mauritius for the IP that has been set up. The important part to remember is that royalty is taxed at 15%, but that there are incentives for tech companies. You can, as long as the substance is in Mauritius, I don't foresee a problem with registering the IP in Mauritius. But again, Ernie's warning here is don't just take it out of South Africa. It's the movement of the intellectual property, and it's not just the question of registering and having the substance in Mauritius.
Sorry, Ernest, yes?
I think it's just important to add on there, the outright sale of intellectual property from a South African resident to a related non-resident is not allowed, or you're not going to get approval for it. The only time I've seen approval on that is where the company has remained a tax resident in South Africa. So you'll typically set up a Mauritian entity or Dutch entity, but however, the entire board of directors, all the profits, everything's flowing back into SA. So that's the only time that I've seen an outright sale. However, there are ways there are obviously methods to intellectual property. A lot of people are using, making use of skills abroad, such as, developers, chief technology officers, and the likes for purposes of having new IP vest in that jurisdiction and the ownership being created in that jurisdiction. But again, I think we're entering into a minefield here, Sarah. So I think that's all on IP from our side.
So I think it's fair to say that this really needs to be explored in a lot more detail, and that such a short discussion would really not do justice to that type of topic. But I see another question's popped up, Ernest, and I think this one's for you. Everyone keeps on talking about substance. What does it mean to us? Explain in layman's terms. What do I need to do to have substance?
Let us say again, it depends, but it's at least this time it's easy to explain on what it depends. At the end of the day, it's a worldwide international tax movement recommended by the OECD that people have people that suitably qualified to act as employees and directors of a company. For example, if you've got an engineering company or an IP company for that matter, that's specializing in developing very specialist IP. If you're setting up a company in Mauritius and your entire board of directors are a bunch of lawyers and accountants who knows nothing about IT, who knows nothing about development, you won't create substance. They're looking at suitably qualified people. Again, for an active trading company, I think the CVs of the directors and people at your point will need to be shown that they adequately qualified to do their job. Passive companies are of course a lot easier. In that case in time, very often the directors just fulfills a fiduciary role. And for a passive company, you can have the director appoint an investment advisor such as Sasfin to manage your portfolio and to manage your passive offshore assets. So active company needs to have suitably qualified people. Passive company, it's allowed for the directors as the fiduciaries of that company to appoint actual professionals who can do it.
Thanks, Ernest. And I see your questions popped up in the chat box, and I don't think there's enough time to answer it because I can see you talking about the subject for quite a few minutes, and I see we are running out of time, but I am going to touch on it slightly. The question was, how can a Mauritian company obtain shares in a South African company if the Mauritian company does not have the funds to buy the shares? And whilst I think there may be too much of a detailed answer on this, I think let's just perhaps discuss funding, because this is an absolute minefield. And I don't want to close off the session without warning business owners that this is probably one of the biggest minefields that you will face. So do you maybe want to just chat to us about those funding options and how intricate it is, so that at least we can warn people that this is a bigger discussion?
I'll answer that for you, Sarah. So the requirement is that funds must flow at a fair value. So it has to be actual movements from funds into South Africa. So you will not be able to bypass that. So if you're looking then at financing option, you again have to look back at who is holding, who is buying it. It can be, again, like Ernest was talking about, that the funds can flow via the structures and with the exchange control approval if it's from South Africa, or it could be, like you said, a minefield. It could be so many options here. It could be an operating company, it could be an existing investment company, it could be an old family trust, it could be a foreign investor that is doing this investment into SA.
Yeah.
Okay, and the tax perspective, Ernest, any comments on the tax minefield side of things?
Yeah, thanks. Sarah, thanks. I actually agree with Anne that funds will need to flow, and it leaves you with that chicken and egg situation of, because funds will need to flow in South Africa, you need to have, you either need to have a fully funded offshore structure, or you need to borrow funds abroad. If you want to borrow funds abroad, you're going to struggle to give South African assets as security for that impact. So again, what we very often see is individuals using their foreign capital allowance to fund a trust. That trust then capitalizes the Mauritian company, and that funds then being used to acquire the shares in South Africa. However, again, when I say, and I think that's a very important point, when you're funding an offshore trust, it's not a case, remember, trust is you're actually divesting assets from yourself and you're giving it to the trustees for the future benefit. So if it's an outright, you can either do it like you're doing an outright donation to a foreign trust, in which case you will be liable for donations tax in South Africa, and you also may be liable for any income arising from that donation. You need to break that link between income arising and the donation. The alternative option is what we very often see people doing is doing a loan to the trust and loaning funds to the trust. However, such a loan must be at the official rate of interest, which is the currency of the loan, which is usually the repo rate +1 of the official currency of the loan. So where you're dealing with, you can make a US dollar loan at a US dollar rate of repo +1. Reaper plus one is a guideline that still needs to comply with transfer pricing regulations. So there's a two. There's the income tax act's actually contradictory in that sense, and they've got Section 7C and Section 31, the transfer pricing that needs to be balanced against each other. But again, happy to advise depending on the relevant circumstances.
Thank you for that. And I think a lot of clients might feel a little bit disconcerted after talking about all the tax and exchange control issues. I would not want to be a business owner, let alone the issues that you're dealing with, to have to consider the multitude of tax and exchange control issues. And the only thing I can add to that is, in the words of Richard Branson, is discipline is the bridge between goals and accomplishment. And I think that stands for every business owner. And I think, Anne, are there any closing comments from you? Otherwise, I think we're going to close off.
No, it's all good. Just invite anybody that has any questions to please contact us on the details that you're going to be sharing.
Okay, thank you so much, Anne and Ernest. And to our clients here today, the session really is intended to highlight broad-based ideas. It's just intended to get you to understand the framework of offshoring a business, and it's also intended to assist you in formulating the questions that need to be asked in order to engage properly with your professional practitioners. So, disclaimer, bunch of attorneys on the session. This is not a DIY guide. It's a rather guidance on so many factors that need to be accounted for in your planning. And this hopefully will direct you towards the sorts of professionals that you need to be engaging with if you are exploring these options. And obviously, as the head of Sasfin Fiduciary, I do want to add that implementing any of the above plans could potentially result in changes to your estate plan. So if you are implementing any of these things, you should be chatting to a fiduciary specialist. I'd like to thank everybody for attending today. We hope you found that this was very informative, and not only informative, also of practical use. And a recording will be sent to you during the week. And if you would like to refer back to this recording, you will find a copy on Sasfin Wealth's Content Hub. So once again, Ernest and Anne, thank you so much for sharing your knowledge and your expertise with us today. And we hope that everybody enjoys the rest of their respective days. And we hope to see you at one of our follow-up series on the topic. Thank you.
Thank you, Sarah. Thank you, and thanks, everyone.
Thanks, everybody.
Bye.
Thank you.